Today I'm with Jeremy Cole, who is a seasoned corporate finance professional whose business is all about selling businesses. And there's one particular type of business sale that most of us have heard about, so management buyouts, but I'm just intrigued to know a bit more. What exactly is a management buyout and when's it a viable option for somebody who wants to sell a business?
Sure. So management buyouts arise in two main situations. The first would be where there's a large group who go through a strategic review and identify a subsidiary that's no longer core to their strategy. So they will often invite the management team of that subsidiary to hire advisors and to look at raising finance to buy the business from the group. And they will often do that before they start talking to potential trade buyers, because a management buyout is a very discreet form of sale. The other typical situation where an MBO opportunity arises is with a privately owned business, owner-managed business, family-owned business, where the owners, the selling shareholders, are quite keen on that discreet aspect of an MBO, and they will often either give the management team a sort of preemptive right to hire advisors and explore funding options to see if they can deliver an MBO offer that satisfies the owner's requirements. And they may do that alongside talking to trade buyers, but ideally they'll give the MBO team first right to look at executing a buyout. Those are the two main situations. There is a third situation where a business gets into trouble, is distressed, administrators are appointed and the management team have an opportunity to buy the business. But the two most likely situations are the two I've described there. Fundamentally, a management buyout is a corporate acquisition, same as any other. The unique aspect is almost all the funding is coming from external sources. So it's a management team raising external funding and buying the business for which they work. The graphic on the screen now shows the kind of before and after legal structure where a business is acquired by a management team backed by private equity. This is showing the legal structure of the business before the MBO, with the shareholder owning the business 100%. The after graphic is showing the legal structure of a typical MBO, where a new company is formed, generally referred to as NewCo, and that is owned by the private equity fund and the MBO team, and sometimes the previous owner will retain a small stake, as we're showing in this illustration. And the NewCo is raising the private equity and the debt to acquire the shares in the trading business from the previous owner. One important aspect that this graphic illustrates is the trading company is unaffected by the transaction. It continues ideally to trade at least as well as, if not better, both during the MBO process and certainly afterwards. So the message, for example, for employees, customers, suppliers on completion of an MBO is very much business as usual. And it's the ownership structure that's changing and the new funding coming in to deliver the MBO.
Yeah. And I guess management teams come in sort of all shapes and sizes. So what makes a particular management team capable and suitable, not just to manage the business, but to become business owners?
I think there's a number of factors, and they're all relevant to the potential funders of the buyout, because with private equity funds and debt providers, they always say that the most important risk factor with any MBO is the quality of the management team. So there's a number of factors. For example, are all the bases covered? Have they, within the MBO team, have they got the all roles within the business covered? Obviously, the CEO in a manufacturing business, a typical MBO team might comprise the production director, the finance director, the sales director, and the CEO. So are all the bases covered? Is the age profile of the MBO team appropriate? If you have a management team that are close to retirement or where a couple of them are close to retirement, that's not ideal unless there's a succession plan in place. And also, are they entrepreneurial? If I'm the business owner and I have to push and prod the MBO team to go out and raise their funding and put together an offer and buy the business, that's not ideal. Ideally, you want, particularly in the CEO position, you want somebody who is knocking on your door as the business owner saying, we'd really like to put together an MBO bid and we'd like to sign advisors and look at exploring the funding. So a naturally entrepreneurial management team is important.
Yeah. And you've hinted at finances. So how do a group of, in essence, employees, managers actually afford to buy a business?
Yeah, that's normally the first question that we're asked if we're in front of a potential MBO team or in front of a business owner thinking of selling to an MBO team. Where does the money come from? Because the individual members of the MBO team normally mortgaged up to the hilt, other personal financial commitments. They don't have millions of pounds sitting in the bank. The beauty of MBOs is almost all the funding is externally sourced, typically from a mixture of private equity, various forms of debt, occasionally some deferred consideration where the owner is prepared to be paid over a period of time for part of the price. The graphic on the screen here shows an illustration of how a management buyout could be funded with a mixture of those types of funding that I've mentioned.
Yeah.
The expectation on the management team in terms of how much funding they're going to put in is typically more a demonstration of commitment rather than a serious proportion of the overall funding.
Yeah.
So if you're a private equity fund putting in 3 or 4 million, or whatever the figure is, into a transaction, you want the management team to be motivated, obviously, in terms of a significant shareholding in the business going forward, but you don't want them to be having sleepless nights because they've remortgaged the house and put too much money in. So as a general rule of thumb, an MBO team is expected to put in 1 to 2 times their annual salary as their demonstration of commitment. So with a team of 4 or 5, you'd be looking at something in the order of between 250 and £500,000 of funding going in from the MBO team personally. And then the remaining funding would come from those external sources.
You've hinted at some of the benefits of an MBO, of management buyout, but if you were summarising the pros and cons for the seller, but also for the buying management team, what are they?
For the management team, and we advise MBO teams on a lot of transactions. In other situations, we're advising the selling shareholders selling to an MBO team. But we enjoy advising MBO teams because it's a fantastic business transaction for a management team to execute. The benefit for the MBO team is partly what is called the benefit of sweet equity or sweat equity, where they're putting in a relatively small proportion of the overall funding in terms of the amount, but they gain a disproportionate share of the ownership of the business going forward. And that's because a private equity fund wants the management team, who they're very dependent on, to be highly, highly motivated. So that translates into a deal structure of the sort that was on the screen a few minutes ago, where 95% of the funding is coming from external sources, but the management team are getting a disproportionate share of ownership. And that, if the business goes well and the financial plan works, should result in them making a very significant financial gain when the business is eventually sold. The downsides for the management team are partly they have to make that personal financial commitment, which for them personally is very significant, and that's not for everybody.
Yeah.
And also the responsibility that comes with owning and running a business. So if somebody is more focused on just turning up for work and doing their job as a finance director or sales director, and they're not of an entrepreneurial leaning, then it's not going to be for them. As this graphic on the screen shows, during the MBO process, the MBO team have two hats to wear. They have to continue to carry on being loyal employees, working for the business, doing their day jobs, but they're also a potential buyer of the business. And similarly, the existing owners of the business are both the boss of those members of management, but also they're the seller of the business. So an MBO team has to be very entrepreneurial to both entertain the process and run the business afterwards. From the seller's point of view, the benefit of an MBO is it's a very discreet form of sale.
Yeah.
You're not opening your doors to competitors. Nobody outside the business other than those funders should be aware of the process. So it's very discreet and relatively controllable by the selling shareholders. And as I mentioned before, occasionally a business owner will give the management team a kind of right of first refusal to have a first go at exploring an MBO, because it's all about the funding, really.
Yeah.
There needs to be evidence of funding at an early stage. And if that's forthcoming, then they can continue down the MBO process through to an eventual sale with or without talking to potential trade buyers. So it's controllable by the selling shareholders. The downside for the selling shareholders is principally in terms of valuation, because an MBO team continues to run the business as an independent business, so there are no synergy benefits that a trade buyer would look to achieve. And therefore, in terms of valuation, you'll tend to find that a private equity-backed MBO will yield a lower price for the selling shareholders than a trade sale. And therefore, that gives them a decision as to whether the benefits of the discretion, keeping the business independent, and having a very highly motivated management team is worth it in terms of any price discount.
And how's the process kicked off? Who speaks to who? How do you get involved? How's it all start?
If we're introduced to an MBO team, which might be through a previous client, friend of a previous client, or by the owner of the business, our first focus is on valuation and funding, and realism is the key here. So without any fee or obligation, we're always happy to devote a decent amount of time up front to meet the MBO team, form a view as to whether we think they're backable, provide advice on valuation, and check that with the owners to see if there's a realistic meeting of minds in terms of valuation, and sense check the funding. So again, without being formally engaged or charging a fee, talk to a handful of private equity funds and debt providers that we know well, and to see, based on an initial briefing, whether they feel the valuation is sensible and they could see themselves as backing the transaction. So there's obviously a lot more work that goes on after that, in terms of firming up the funding and the terms with the selling shareholders. But where we're advising an MBO team, we actually want to invest that time up front without being paid, because otherwise we're going to spend a lot of time and end up not being able to raise the funding, or the selling shareholders having an unrealistic view on valuation. Yeah. So there's that, what you might call a feasibility phase that we do typically without charge. And then if the two boxes are ticked in terms of evidence of funding and evidence of the selling shareholders being realistic, then we're formally appointed and we go into the more detailed stages of the process.
Okay. And from that feasibility stage to the day we actually sign on the dotted line, typically how long is that process?
If it's the owners giving an MBO team a preemptive right to explore an MBO before talking to trade buyers, and it goes through the stages without the need to talk to trade buyers, it should be no more than 5 to 8 months, something like that. Can be quicker. Mainly depends on how quickly we find the funders who are appropriate and willing to back the transaction. And at the slower end, that tends to be the case if the selling shareholders and their advisors are also talking to trade buyers. Yeah. So then the MBO team become one of a number of potential buyers, and that process inevitably takes longer, typically 8 to 12 months. A really important point to bear in mind is The MBO team needs separate corporate finance advisors. You can't have the same advisors advising the selling shareholders and an MBO team. So we advise on both those situations, but in every situation, we are either acting for one party or the other, not both, because of those two hats that I mentioned before.
Yeah. So if there's a successful management buyout, those 3, 4, 5 individuals, so further down the line, how do they sort of realise their investment? Can one of them sell their shares? Do they all need to sell their shares? How does that resale work?
So if you had a management buyout team who owned, say, 45% of the business and the private equity fund owned 55%, and say there were 4 individuals within that MBO team, there's a number of different possibilities. So the simplest and cleanest form of exit, because private equity funds are focused in achieving an investment return and an exit, typically within 4 to 5 years. The simplest form is everybody sells at the same time. So the MBO team and the private equity fund go into a sale process where they might sell to a trade buyer, for example, and the management team sell all their shares and the private equity fund sell their shares at the same time. So that's the simplest form of exit. Frequently, it's slightly more nuanced than that, in that after, say, 4 years, there might be an offer from a trade buyer and the private equity fund might be keen to accept that and exit, but the management team might want to carry on having a stake in the business and owning the business. So they may partner up with the private equity fund that's made the approach, and they may continue, hopefully at a higher valuation than the original transaction. So the management team will continue to have a shareholding, and the private equity fund that originally backed them will have exited.
Yeah.
And again, there's subsets of that where you might have one of the shareholders, one of the managers who reaches retirement age in the absence of an offer from a third party, and the other members of the team may buy that person's shares. So there's lots of different forms of exit, but the fundamental truth is that the private equity fund are investing on day one with a view to making an investment return. That's their only agenda. So they will want some form of exit, typically within 4 to 5 years, and the management team will then have a decision. Either they will want to carry on, either all of them or some of them, as shareholders with a new backer, or they'll all exit together.
Okay. And just personally, Jeremy, do you provide the strategic input up front? Do you project manage the process? Do you delegate the whole process to a colleague? What's your involvement?
We always market strongly when we're pitching to an MBO team that I or my business partner will be involved in the process from beginning to end. So we roll our sleeves up and get involved in great detail with helping the MBO team through the process, partly because they have their day jobs to do, and partly because it's a very specialist process. Dealing with private equity funds, debt providers, is quite a complex process. So we're involved in great detail from beginning to end, certainly with the project management side, certainly with the dealing with the financial aspects of the transaction, obviously. And then there's the emotional issues that we talked about before. So no, my business partner and I don't sit up high and dispense wisdom and leave a team of people to do the detailed work. It's much more involved than that. We're obviously supported by colleagues, but we lead the process from beginning to end.
Okay, so if we actually meet you, you'll be involved in the whole process, start to finish.
Very much so, yeah.
Okay, great. Okay, that's smashing. Thanks very much, Jeremy.
Thank you.